Many traders spend years in the market without seeing any real results. If that's you, then this video is exactly what you need. The truth is, most traders fail because they trade like retail traders, while the small percentage of winners think and act like institutions. So the real question is not, what is the best strategy or indicator? The real question is, how do institutions trade, and how can you trade like them? In this video, you will learn how to identify valid bullish and bearish institutional zones in the market, how market maker cycles really work, and how they move price, how to confirm institutional zones using a professional trading checklist, how to recognize the bait and switch tactics used by institutions, how to avoid 2 critical trading mistakes that can ruin your account, and real chart examples so you can apply everything step by step. Before we dive in, make sure to like this video, subscribe to the channel, and turn on notifications so you don't miss any future trading lessons. With that being said, let's get started. Have you ever seen the market move up and then suddenly drop aggressively? Or move down and then explode to the upside? This is not random. These moves are not caused by retail traders. They are institutional moves that were planned in advance. Look at this example. The market moves up, reaches a specific level, then retraces back, returns to that same area, and pushes higher again with strong momentum. Now look at another example. The market moves down, reaches a key level, then retraces back, comes back to that area, and drops again aggressively. This is not random. These reactions happen for a reason. So the real question is, how can you identify these areas in advance, before the move happens? That's exactly what you're going to learn in this section. So make sure you don't skip anything, because every detail matters. Now, there are 2 main types of institutional zones in the market. The first one is the bearish institutional zone. This is an area where institutions consider price to be expensive, so they place sell limit orders. When price returns to this zone, those orders get activated, and the market moves down aggressively. The second type is the bullish institutional zone. This is where institutions consider price to be cheap, so they place buy limit orders. And when price reaches this area again, we often see a strong move to the upside. Now, how do you identify a valid institutional zone? To answer this, you first need to understand how institutions actually operate in the market. Look at this chart example. As you can see, the market makes a strong move to the downside. This is not a retail move. This is a clear institutional move. And this move is the most important part for us. Why? Because institutions cannot enter the market all at once. They need liquidity. So, instead of selling everything at one price, they build their positions gradually and place limit orders within a specific price area. This area becomes what we call a bearish institutional zone. After the move, the market starts to retrace. And when price returns to that same area, it has a high probability of moving down again. Why? Because unfilled institutional orders are still sitting there. So when price comes back, those orders get activated, and the market reacts. This initial move is what we focus on, because it represents the institutional footprint left in the market. And your job as a trader is simple. Identify that footprint, mark the zone, and wait for price to return. Now look at another example. Here, the market makes a strong move to the upside. This is a clear, bullish, institutional move. Now watch what happens next. As price retraces back to the bullish institutional zone, it gets rejected and continues higher with momentum. This confirms that institutions were active in this area and are defending their positions. At this point, you should start understanding the logic behind these movements and why price reacts the way it does. But here's the problem. Not every strong move represents a valid institutional setup. So how can you tell the difference? To solve this, you need a professional framework, a checklist that helps you confirm whether a zone is truly driven by institutional activity or just market noise. Let's go through it step by step. Filter number 1, strength of the move. When institutions enter the market, they create strong, decisive moves. You will notice large candles moving in one direction with very little hesitation. This is what we call a clear institutional footprint. But if the move is weak, inconsistent, or full of wicks, then it's not a reliable signal. That's a setup you should ignore. Filter number 2, untouched zones. A valid institutional zone is usually fresh. This means price has not returned to it since it was created. Why is this important? Because unfilled institutional orders are still present in that area. The first time price comes back, those orders are more likely to be triggered, creating a strong reaction. But once a zone has been tested multiple times, its strength decreases significantly. Filter number 3, structure shift. High-quality institutional zones often form after the market breaks an important level. This could be a previous high or a previous low. This break is not random. It's a move designed to capture liquidity and shift control in the market. When a zone forms after this kind of move, it becomes much more reliable. Filter number 4, trade quality. Before entering any trade, you need to evaluate the potential reward compared to the risk. A strong setup should offer at least a 3-to-1 reward-to-risk ratio. If the trade does not meet this condition, it is not worth taking. Because over time, your profitability depends on discipline, not just accuracy. Now, let's look at a real chart example and apply everything step by step. As you can see here, the market makes a strong move to the upside. So the question is this a valid bullish institutional move or just noise? Let's evaluate it using our checklist. First, candle strength. As you can see, the candles are large, clean, and moving in one direction. This shows strong buying pressure. There are no significant bearish candles, which means sellers are not in control. This is a clear, bullish institutional footprint. But this alone is not enough. Let's move to the second filter, freshness of the zone. As you can see, this bullish institutional zone has not been revisited. It is completely fresh. This tells us that institutional orders may still be resting in this area, waiting to be filled. Now let's look at the third filter, structure shift. Here, the market breaks above a previous resistance level. This move takes liquidity, triggers stop losses, and confirms a shift in market structure. This is a strong sign of institutional involvement. Finally, let's evaluate the trade potential. As you can see, this setup offers at least a 2-to-1 reward-to-risk ratio, which makes it a valid and interesting trading opportunity. So based on our checklist, we can conclude that this is a valid bullish institutional move. Now look at what happens next. The market retraces back to the bullish institutional zone, touches the zone, gets rejected, and then continues moving higher with strong momentum. Now let's look at another chart example. As you can see, the market makes a move to the downside. But take a closer look at the candles. They are not strong. We see wicks, we see hesitation, and even some bullish candles inside the move. This tells us that sellers are not fully in control, and buyers are still pushing back. So this is not a clean institutional move, because when institutions enter the market, the move is strong, decisive, and consistent. Now here's an important rule. If the first condition of the checklist is not met, you don't need to check anything else. You simply ignore the setup and move on to the next opportunity. Now let's look at another example. Here, the market makes a strong move to the upside. The candles are clean, large, and moving with momentum. So this is a clear bullish institutional footprint. The zone is also fresh. It has never been tested before. And we can see a break above the previous resistance, which confirms a shift in market structure. So far, everything looks perfect. But now let's check the final condition, trade quality. As you can see, the reward-to-risk ratio is less than 2-to-1, which means the potential reward is not worth the risk. So even though the setup looks clean, we still ignore it. Because discipline is what protects your capital in the long run. Now let's look at the last example. Here, the market makes a strong move to the downside. As you can see, the candles are large, clean, and bearish. There is no significant buying pressure, which means the first condition is clearly met. Next, let's evaluate the zone. The zone is fresh. It has never been tested before. So the second condition is also satisfied. Now, let's look at the trade potential. As you can see, this setup offers a reward-to-risk ratio greater than 2-to-1. which makes it attractive from a risk perspective. But here's the problem. One important condition is missing. The market did not break below the previous support level. And this condition is critical. Because a breakout of support means that liquidity has been taken, and that institutions have likely entered the market. Without this breakout, we don't have confirmation that institutions are truly behind the move. So even though the setup looks clean, it is not a complete institutional setup, and the trade should be ignored. I hope these examples help you clearly understand how to identify valid institutional moves, and more importantly, how to avoid the weak ones. Now let's move to the most important part of this video, the entry signal. When price returns to a bullish or bearish institutional zone, it does not mean you should enter blindly. Look at this example. As you can see, all the conditions are met, but the market does not respect the zone. This happens frequently. So does this mean the strategy doesn't work? No. The method works, but the zone alone is not enough. You still need confirmation. Now let's look at another example. Here, we have a clear, bullish institutional zone. Price retraces back into the zone. And then a pin bar candlestick pattern forms. This pin bar shows a strong rejection of sellers. It tells you that buyers are stepping in, and that institutions are likely defending their positions. So, the first confirmation signal you can use is the pin bar. Now let's look at another example. Here, we have a bearish institutional zone. Price retraces back into the zone, and then forms a strong bearish engulfing pattern. This candle shows that buyers were rejected aggressively, and that sellers have taken control. This is a clear confirmation that institutions are active in the zone. So instead of entering blindly, you wait for price to return to the zone, and then you look for a clear rejection signal. That's how you trade with precision, not emotion. If you want to learn more about candlestick signals, make sure to check out the candlestick patterns lesson in this playlist. Now, at this point, you have built 3 essential skills. How to identify institutional zones, how to validate institutional zones using a checklist, and how to confirm your entries using price action signals. But is this enough to start trading? No. You still need one more layer, and it's critical. Top-down analysis. Let's look at this example. On the 5-minute chart, we have a clear bullish institutional zone. The move is strong, with large bullish candles, which shows clear buying pressure. The zone is fresh. It has never been tested before. We also have a break above the previous resistance, which confirms a shift in structure and a liquidity sweep. And the reward-to-risk ratio is attractive. So everything looks perfect. Now let's see what happens next. Price retraces back into the bullish institutional zone, and a tailed bar forms. This is very important, because what happens inside the zone tells you everything. This tailed bar shows rejection. It tells you that sellers were unable to push price lower, and that buyers stepped in. This is your confirmation. Now here's the key step most traders miss. This setup is on the 5-minute time frame. But before entering, you must check the higher time frame. So we move to the 1-hour chart. As you can see, the market is trending up. This aligns perfectly with our bullish setup on the lower time frame. And alignment is critical. If the higher time frame does not support your trade, you ignore the setup. Now we go back to the 5-minute chart. You enter at the close of the confirmation candle. You place your stop loss below the signal candle, and your target is the next key level. Now look at what happens next. The market moves up exactly as expected. Now let's look at another chart example. As you can see here, we have a clear, bearish institutional zone. The move is strong, with large bearish candles, which shows strong selling pressure. The zone is fresh. It has never been tested before. We also have a break below the previous support, which confirms a shift in structure and a liquidity sweep. And the reward-to-risk ratio is attractive. So at first glance, everything looks perfect. Now look at what happens next. The market retraces back into the bearish institutional zone, and a bearish pin bar forms. This looks like a valid confirmation signal. It suggests that buyers were rejected and that sellers may take control. But we are still missing one critical step: top-down analysis. This setup is on the 5-minute time frame, so we need to check the higher time frame. Let's move to the 1-hour chart. As you can see, the market is trending up. This means the higher time frame is bullish, while we are trying to take a bearish trade. So there is no alignment. And this is where most traders make mistakes. Even if everything looks perfect on the lower time frame, if the higher time frame does not support your trade, you must ignore it. Now, let's assume you ignore this rule and take the trade anyway. You enter at the close of the signal candle. You place your stop loss above the candle, and your target is the next level. Now look at what happens next. The market does not respect the zone, and the trade fails. And this is exactly why top-down analysis is critical. Because without alignment, even the best-looking setups can fail. And this is something that can easily confuse traders if they don't understand the bigger picture. Now, at this point, you have built the following skills: how to identify institutional zones, how to evaluate institutional zones using a checklist, how to wait for confirmation signals, and how to use top-down analysis to trade with the trend. But even with all of this, you can still lose money. Why? Because of common trading mistakes. And in this section, I will show you 3 critical mistakes that can completely destroy your account if you don't understand them. Let's start with the first one: falling into the market trap. Look at this chart example. We have a clear bullish institutional zone. Let's evaluate it. The candles are strong and show clear buying pressure. The zone is fresh. The previous resistance has been broken, confirming a shift in structure. And the reward-to-risk ratio is attractive. So everything looks perfect. Now look at what happens next. The market retraces back into the zone, and a doji candlestick pattern forms. You wait for confirmation. You check the higher time frame. Everything aligns, so you enter the trade. You place your entry at the close of the candle, your stop loss below the zone, and your target at the next key level. But then, the market drops, hits your stop loss, and then moves exactly in your direction, without you. At this moment, most traders feel frustrated. They think the market is against them. They feel like someone is watching their trades. But this is the wrong mindset. What you are seeing here is not manipulation against you personally. This is a market trap. The market moves in a way that triggers stop losses to collect liquidity before moving in the intended direction. So instead of reacting emotionally, you need to observe what actually happened. In this example, after the stop loss is taken, the market closes back above the bullish institutional zone. This is a key signal. It tells you that the move down was a liquidity grab, not a true reversal. And this is where smart traders act differently. Instead of getting frustrated, they re-enter the market with confirmation, and then they ride the move in the correct direction. Now let's look at another chart example. As you can see, we have a clear bearish institutional zone. Let's evaluate the setup. The candles are strong, bearish, and show clear selling pressure. The zone is fresh. The previous support has been broken, confirming a shift in structure. The higher time frame aligns perfectly with the trade, and we have a strong confirmation signal. So everything looks ideal. You enter the trade at the close of the signal candle. You place your stop loss above the zone, and your target at the next key level. Now here's what makes this setup even more interesting. It offers a reward-to-risk ratio of 5-to-1, and trades like this don't happen often. Now look at what happens next. The market starts moving in your favor, but then it pulls back slightly, and this is where most traders fail. You start to feel fear. You don't want to lose your profits, so you close the trade early before it reaches the target. But this is a mistake. As I said before, the market will always test your emotions. It will not move in a straight line. It will go up and down just to create doubt. And if you don't respect your target, you destroy your risk-to-reward ratio. And over time, this will destroy your profitability. Now let's see what happens if you stay disciplined. If you ignore the noise and let the trade play out, as you can see, the market eventually reaches the target and delivers the full 5-to-1 reward to risk ratio. This means that even if you lose 4 trades in a row, one winning trade like this makes you profitable. But if you close your trades early, you lose that edge completely. So I hope this video helps you understand how to identify, validate, and trade institutional zones with confidence. If you found value in this video, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next lesson. Thank you for watching, and see you in the next video.